We have John Hilsenrath in the studio this morning to talk about the Fed and how likely that is. Joining us right now is Stifel Chief Economist Lindsey Piegza. Lindsey, good to see you. Thanks very much for joining us. Are you betting on a rate cut?
Good morning. I do think the Fed is increasingly being backed into a corner. So it's really not a question of if the Fed is going to cut rates from here, but when and by how much. And we could see that first rate cut coming as early as the March FOMC meeting. The expectations for a Fed rate cut have risen dramatically, where it's now being priced in well over 50%, with a second round rate cut potentially coming as soon as April or even June. So right now the market is very concerned about the fragility of the domestic economy via the contagion of what's happening overseas, and that is going to back the Fed into a corner to either provide outright stabilization or further stimulus.
Yeah, John, look at these
economy.
Interest rates. What are you hearing? Assess the situation for us, John Hilsenrath.
Well, the Fed, I think Lindsey is right when she says they're being backed into a corner. So, you know, even if we haven't seen like real economic impacts in the U.S. right now, we've seen impacts in financial conditions. We've seen the dollar getting stronger, stocks getting weaker, and then the yield curve, which the Fed looks at very closely, inverting, meaning long-term interest rates are lower than short-term interest rates. These are all signals that the Fed takes that it's time to cut interest rates. So they might have to react based on what's happening to financial conditions, in part to affirm the market's belief. They could make a bad situation worse if the market is pricing in Fed rate cuts and they turn around and say, no, we're not going to do it. So, you know, I think that's something that that the Fed has to look at very carefully. And, you know, we've got a meeting coming up in March. And they tend to be a very inertial institution. They tend not to move, you know, they don't want to panic people.
Yeah.
So maybe we get a signal in March and then a move later on. We'll have to see how Jay Powell responds.
But, Lindsey, it's Dagan McDowell. Would a Fed cut do anything? Because again, do anything to actually give an economy a ballast or a bottom. Because I look at these assets selling off, and they were inflated. Looking at junk bonds, just as an example, because of the massive amount of liquidity that's being pumped into the financial system, not just here, but here, there, and everywhere.
You make a great point, because rates are already at very historically low levels. We're talking about the Fed funds in a range of 1.5 to 1.75%. So arguably an additional 25, 50 basis points is not going to give the boost to investment and consumption that you would typically expect as the Fed lowers rates. But it could help on the margin. It could also help increase confidence that the Fed is ready and able to take preemptive action to stabilize the economy. As your previous guest mentioned, we haven't seen the impact in the data yet. And in part, we won't until the second quarter because of that delay in terms of delinquent deliveries and overseas manufacturing hitting U.S. producers. So the Fed has to make the decision if they want to take that preemptive action and stabilize the economy ahead of the hardest hit time frame. And I do think the Fed is increasingly looking at the market, looking at the increased concern, and they may, in fact, have to play those cards early.
Lindsey, you say this could increase confidence if the Fed moves. I wonder actually if it could have the opposite effect, because the Fed doesn't have a lot of room for action. If they take some bullets, you know, shoot some bullets, now they've got fewer to shoot later on if things get even worse in the economy. So, I mean, do you worry that the situation the Fed is in right now is going to have investors saying, oh, wait a second, we don't have a safety net outside of the Fed to do anything if things get worse?
Well, I think the reality is we don't have much of a safety net this time around, regardless of whether or not the Fed moves in March. When we look at the Great Recession, when we look at 2001, the Fed cut rates over 400 basis points. This time around, we only have 150, and that's a reality that the market has already priced in. But given that we have such little room between where we are now and the zero lower bound, I would argue that the Fed doesn't have the opportunity to be patient and slow play this, that they need to get out ahead of the weakness and cut rates sooner and faster than they normally would because of that limited spread between rates at the current level and, again, that zero lower bound.
Yeah. Lindsey, before you go, real quick, is there any reason to think that now is an opportunity to buy stocks, or does this get worse?
Well, right now, I think the two main scenarios for the U.S. economy is not so great and worse. In either case, we are looking for Fed action and a noticeable slowdown in top-line growth, which should keep downward pressure on both risk assets and yields. So it's going to be a very difficult investing environment for the short term.
Sounds like sit on cash for a little bit here. Lindsey, good to see you this morning. Thank you very much. Lindsey Piegza joining us. Be sure to stay tuned for our Reserve President and